My model is rule-based and laser-focused on quality setups. I don't trade just to trade. To avoid chop, I've set up very specific filters and time-based rules. I only trade during high-probability windows and stick strictly to the 1-minute, 15-minute, 4-hour, and weekly charts. Confluence is the backbone. I rely on the initial balance to filter out messy price action, and I only engage when there's a liquidity grab paired with a confirmed market structure shift. My entry and stop-loss rules are tight, no guessing. Every trade is either a higher time frame reversal or continuation setup. And before I pull the trigger, I look for divergence using smart money technique. When that shows up, especially near key levels, it's usually a signal we're about to reverse hard. That's the extra layer of confirmation that gives me conviction. Let's move to the weekly chart. I've mapped out the key long-term and short-term highs and lows. Right now, we're hovering near the 50% equilibrium level of the current weekly dealing range. The E-mini S&P 500 and the NASDAQ have already swept 2 short-term lows. That's key. But here's the thing. We haven't seen any smart money divergence yet. That's my clue that this drop might not be done. Without divergence, I'm not convinced it's a reversal. So the expectation is we might push lower, possibly sweeping a long-term low before we find real support. That would set up the conditions for a proper shift in sentiment. And that's what I'll be watching for. This gives me my macro directional bias for the week. Now, on the 4-hour chart, here's what we're watching. We've already pushed down and taken out 2 higher time frame weekly short-term swing lows. After that, price rejected sharply and gave us a strong new week opening gap to the upside. Price then rallied, filled the NWOG, and rejected perfectly from a bearish 4-hour fair value gap. You'll notice that rejection came right at a long upper wick, tapping directly into that gap. That fair value gap also lines up closely with the 50% level of the current 4-hour dealing range, depending on where you draw your high. Based on the high I've marked, we rejected right from that midpoint, which puts us in a premium zone. Not the deepest premium, but still a premium, meaning we're expecting a potential move lower. From here, I'm watching for price to drop into the 4-hour bullish fair value gap below, and then potentially push higher from there. That said, let's be clear, the market can absolutely push higher straight from here. This is speculation. We're never certain, and that's okay. But ideally, we'd want to see price push higher into the 62 to 79% range of the 4-hour dealing range, or even sweep the short-term swing high before dropping lower again. We're not expecting a full run to all-time highs just yet, especially considering the current state of things in the US economy. On the 15-minute, I've marked the Asia session highs and lows, as well as short-term internal structure. This week's new week opening gap is still in play, even though the midpoint has been filled. It's still acting like a magnet. Below current price, we've got a stack of liquidity. The Asia low, London low, the midpoint of the 4-hour fair value gap, and the new week opening gap midpoint. All signs point to a potential liquidity sweep lower before any real reversal. Zooming into the 1 minute, we finally got smart money divergence at the highs. Nasdaq made a higher high while the E-mini S&P didn't. That was followed by a clear market structure shift. The first real sign that the bullish move might be done. With a higher time frame bias still bearish, this gave me confidence to look for short setups. That combination, divergence and a shift, is what I wait for. Quick look at today's economic calendar. Nothing major. There are no Fed speakers, no high-impact news releases, and earnings from the big players only coming later this week. So, we're likely in a technical-driven market today. That means we can trust the levels and structure a bit more, but it also means we need to be careful about volume fading out later in the day. Low news equals low impulse, but also low noise. First trade of the day, short. Price pulled back into the dealing range, right into a premium fair value gap on the E-mini. At the same time, the Nasdaq pushed just slightly above its 50% level and rejected. Clean confluence. Entry was precise. I kept the stop tight, $8 of risk. As price started to move, I shifted the stop to break even to protect capital, then gave it a bit more room above the swing high, and finally pulled it back to break even when momentum slowed. Eventually, I got stopped out at break even, but that's totally fine. No loss, no damage, just a managed trade. I followed the plan, and that's what matters. In this model, break even is a win if the setup fails to deliver immediate momentum. Second trade, this time a buy setup. We saw a strong rejection off the 50% level of a bullish fair value gap. The 15-minute chart was still showing higher highs and higher lows, so the directional bias was intact. Risk was $3, targeting 6. But even though the structure lined up, it wasn't the cleanest setup. Momentum was stalling. I moved the stop to break even quickly, again, just protecting capital. Price reversed shortly after and took me out. 2 break-evens in a row. That's part of the game. No damage, no tilt. Discipline stayed intact. Downside move was strong, big red candles, lots of momentum. The retracements were weak, no strong bullish candles. Price remained inside the initial balance, which usually signals consolidation and potential manipulation. We're waiting for the real move. No clear structure break yet. This is where things got interesting. We had another push lower, and this time I caught a solid 1-minute market structure shift. Price tapped into a fair value gap between the 62 and 79% levels of the dealing range, high probability entry zone. I entered 2 shorts. First one had $4 risk and made 12. Second had $4 risk and made 37. Both were managed actively. But here's the thing, I didn't wait for a pullback first, and price didn't break any major swing low. So I moved both stops to break even once price slowed, and yes, both got taken out again. We're seeing a clear pattern. Price is reacting to levels, but refusing to follow through. It's a range-bound day, textbook consolidation before expansion. Still, these trades were valid. I executed according to the plan. You don't force profits, you position for them and let the market decide. Wrapping up the session, no big moves, just chop. We're consolidating within the London dealing range, and volume is drying up. There's no benefit to forcing a trade late in the day when the setup isn't there. Sometimes, stepping aside is the best move. Even though I took 4 entries today, none resulted in a profit, but none resulted in a loss either. Each trade followed the model. Each one had structure, confluence, and risk management. Execution was solid. And when the real opportunity comes, with volume, momentum, and clean structure, I'll be ready to strike. That's the game. That's it for today's session. For trades, all break even. No wins, no losses, but that's a huge win in itself. Why? Because I stayed disciplined. I stuck to my rules. I waited for setups, took them with precision, and protected my capital. This model is built for longevity, not hype. If you found this breakdown helpful, make sure to subscribe and drop a comment. I'll be dropping more of these full model walkthroughs soon. Until next time, stay sharp, stay patient, and stick to your edge. Peace.